Hi everyone, welcome to Chapter 2, Analyzing and Recording Transactions. So for an organization, a company, sole proprietorship, partnership, this term we're talking about sole proprietorships mostly. When something happens in your organization, it needs to be recorded. Okay, we've talked about this several times. And there's a set way to ensure that it's being recorded properly. And that's what we're going to learn in this chapter. The first thing we're going to do is look at what they call the accounting cycle. Okay, this is how everything goes full circle, full cycle, so that when a transaction happens, it ends up in your financial statements. So we analyze the transactions by figuring out what actually happened and making sure that something actually did happen. Then once we figure out what happened, such as you bought supplies and paid cash, okay? Then we have to record it, okay? And that's considered number 2 where it says journalize. Then we're going to post. Then we're going to prepare what's called an unadjusted trial balance, okay? And a trial balance, as you'll see later in this chapter, is where all the balances from all of the accounts at the end of the period are listed to make sure that you see it all on one piece of paper or on one screen, and you can see if the numbers make sense. If you discover at this point you need to make some adjustments, that's where you journalize the adjustments. Then we prepare another trial balance just to make sure that everything looks good. And again, with a trial balance, you can make sure as well that everything balances so that when you end up creating your balance sheet, as you know, all of your assets will equal your liabilities and your equity. So again, we need to ensure that it balances, and this is the statement that the report that we use to initially trial to make sure that it does balance. Then from there, we create financial statements. And then at the end of the year, there's certain accounts that close down to zero because each year they start fresh. And those would be accounts such as those you'd find on an income statement. Then we would have what they call a post-closing trial balance to see what our ending balances are. In this course, we're going to touch on most of these steps, but we will not be looking at an unadjusted trial balance, and we won't be making adjusting entries. Okay, so the account. In an account, you have a detailed record of increases and decreases in the specific asset, liability, or all of the equity items, okay? So as you saw at the end of chapter 1, where we posted into the columns of assets, liabilities, and equity, how after each transaction happened, it's still balanced. And that's what we're going to do here is learn how to post so that everything that affects cash, for example, is going to be recorded under cash. Okay, so we're going to start by looking at more detail at assets and liabilities and the equity accounts. So a general ledger is a report where it lists all of your accounts and you're able to keep track of the balance in each of your accounts. Okay, so let's start with assets. Assets are resources or items owned by a business with three key attributes. The transaction to acquire the asset has happened. Okay, so we haven't just thought about or talked about buying that truck. We actually bought the truck. Okay. The company has control over the asset and there's future benefit in that item. So we're going to have that truck for a very long time. And another key attribute is that assets are used in the organization in order to create revenue. So we need that truck in order to plow the driveway or to deliver that mail. Okay. So asset accounts are often intuitive in nature. For example, cash, supplies, inventory, land, building, and equipment are all examples. Two other key words, we've talked about this a little bit already, but two key words to watch for and are very clear indicators that it's an asset are receivables, such as accounts receivable. We're due to receive that money from our customer, and prepaids. One that we talked about already is prepaid rent or prepaid insurance. We've paid for it in advance. We haven't used it yet. So prepaids are also assets. Okay, so we've talked about accounts receivable. Notes receivable is a promissory note, but again, it's a receivable, so we're due to receive money from a company in the future because we have provided them with a service. Prepaid expenses, as I mentioned, prepaid rent, prepaid insurance. We haven't used it yet. So if you prepay your rent by 2 months or prepay your insurance by a year, there's value left there. We haven't used that service yet. Liability accounts are obligations of the business that have two key attributes. They are a present obligation as a result of a past event. So for example, power bill. You use the power and then you get a bill. So the past event is the use of the power, and then the present obligation means you now need to pay for it or pay for it within the next 30 days on the due date. And the company has an outstanding obligation to pay via transfer of an asset or provision of a service. Okay, so again, two words, payable and unearned. So if somebody pays you a deposit to get you to do some work for them in the future, that's called unearned revenue. And you are liable to either pay them back or provide them with that service. And then the payable, for example, accounts payable, again, you used that service and now you're due to pay your bill. So if you still owe somebody something for something that they've provided you, like power, it goes under accounts payable. Accounts payable, we've talked about. Notes payable, very similar. It's just longer term. It's not within 30 days. Maybe it's within 6 months. Unearned revenue, I mentioned that as well. Equity accounts, okay. So our revenue and our expenses are equity accounts, but they go on our income statement. And then once we know revenue minus expenses gives us either a profit or a loss, that profit or loss is carried forward to the statement of changes in owner's equity. Then our withdrawals by the owner also goes on our statement of changes in owner's equity, and so did the investments by the owner. Okay, investments increase our equity, withdrawals decrease our equity, revenue increases our equity, and expenses decrease our equity. Then once you've completed the statement of owner's equity, the closing balance gets carried over to your balance sheet. Okay. At this point, I'm going to stop and create a new video. We are at the 11-minute mark.